Welcome to Impact Makers Radio, helping you to find jargon-free information before choosing a professional to help solve your problems and live the life you love. And here's your host, Stewart Andrew Alexander.
Hi, and welcome to another Let's Talk Retirement conversation. And during this segment of the show, ladies and gentlemen, I have a certified financial planner, Charles Korger, partner of Carson Choice Retirement Solutions, Inc., and he's calling in all the way from Bala Cynwyd in Pennsylvania. Now, Charles, who has a wealth of financial planning experience, will be talking to you today about a very interesting topic. You see, Charles is here to speak about keeping your emotions out of investing. Now, that sounds like a very interesting topic. So, if you are one of the increasing numbers of individuals in the Bala Cynwyd area and you're out there wanting easy to understand jargon-free information around today's topic of keeping your emotions out of investing, then you may just want to down tools, give yourself a break, log out of Facebook, take a break from work, whatever it is that you're doing. You may even want to grab yourself a notepad and pen and get ready to take some copious notes as we listen in to what Charles has to share with us today. Now, I may swing back and forth between Charles and Chuck because Charles is his official name, but he goes by all his friends and colleagues by the name of Chuck. So please forgive me if I do switch between the two. However, I'm sure what Chuck has to share with us today is going to be really useful for you. So that said, let's not keep him waiting any longer. He's a very busy man. Welcome to the show, Chuck.
Thank you very much, Stewart. Glad to be here.
Okay then, Chuck, it goes without saying that anything you share with us today is not legal advice or legal assistance. It's purely for the purpose of disseminating information. Now, can you just spend a moment just to expand on that in your own words, please, so that all the listeners out there are absolutely clear what we're trying to achieve today?
Yes, absolutely, Stewart. No problem. Anything that I'm going to share today is absolutely just my opinion and from my own experience over roughly 30 years in the investment industry. But as we all know, you can ask 100 advisors a question and you're going to get 100 different answers. These opinions and answers that I'm going to give today are based purely on methods that I have seen successful with my clients. It may or may not be right for every other individual.
Fantastic. Thanks for sharing that with us then, Chuck. So take a moment to tell us a little bit about your company, Carson Choice Retirement Solutions, Inc., and the people who you serve and the various kinds of situations that they find themselves in when they come to you for your help.
Absolutely, yes. At Carson Choice Retirement Solutions, we are a fee-based comprehensive wealth management firm. We serve clients really in all phases of their financial lives, whether they're young and accumulating their retirement savings, or mid-career in their peak earning years and making some key decisions, or approaching retirement, or even more importantly, on into retirement, to making sure that those assets are retained and sustaining for the lives of my clients. Typically, clients come to us, they just really don't know where to start. They need help in prioritizing their issues, and what we really do in that wealth management arena is we bring clarity and peace of mind to our clients' lives. We also, in our firm, have a retirement planning section of the business, which we've written a book about in the 401k and profit sharing plan world.
Okay, so in your experience then, Chuck, what are the advantages of keeping emotions out of investing?
Well, the biggest advantage is that we don't do something that's going to hurt us. It's human nature sometimes to shoot ourselves in the foot, thinking that we can overreact or react in a way smarter, better, faster than someone else. Keeping emotions out of investing is going to allow you to really make sure that the markets are working for you and you're going with the flow of the markets as opposed to them working against you and you fighting against that stream. It allows you to really focus on what you can control and really block out that noise and avoid the rest. Focus on the things like diversification and keeping your costs low and remaining disciplined, meaning staying in the market.
So there's a lot of information out there, a lot of beliefs surrounding your industry then, Chuck. What do you feel are one or two of the biggest myths out there when it comes to investing?
Well, I think one of the biggest myths around investing, and especially around maintaining a disciplined investment approach, is that doing nothing is a bad thing. As human nature, we feel that we have to react when there's a situation and we have to fix it. Sometimes things are beyond our control. I can't control the day-to-day movements of the market. I can't control a geopolitical event that causes a crisis in the market. I can't control great earnings numbers that causes a huge spike in the market. All those things that we don't know for sure, that are beyond our control, that nonetheless our human nature tells us that we should try to outguess or outsmart or have a crystal ball to try to have a solution. If we can just focus on those things we can control, the markets will work for us. And I guess a part of that too, one of the keys within that is just, I think this underlying idea that as investors or humans, successful investing means being able to time the market, meaning knowing when to get out of stocks and into bonds, or when to be in Europe or in the U.S. and in emerging markets or out of emerging markets. All those things that really, no matter what credentials you have, how much experience, what your name is, none of us can predict the future. We don't have that crystal ball.
Right. It would be great if we had that crystal ball, wouldn't it?
Right.
In a utopian world. So listen, Chuck, you alluded to earlier that you've been in 30 years in the investment industry. Now, I could only imagine that within that span of time that you've come across many misconceptions surrounding your industry. So please share one or two of those common misconceptions that you come across on a regular basis while you're out there speaking with your clients.
Well, I think I probably alluded to one of those in my last comments, but just this idea or concept that as an advisor, it's my job to tell you, which company, which stock is going to be best this year or the next 5 years, which ones aren't going to be any good, which countries are going to be the best, which are going to be underperformers. Again, alluding to being able to predict the future, which none of us can do. Yet that's what, if we were brought up on Wall Street or in the insurance industry, that's been bred into us or taught into us that that's supposed to be what our job is.
Right. Any other misconceptions that you'd like to share with the listeners today?
And then I think the other thing is just that all financial advisors that people think that we're all stockbrokers, meaning that I'm going to be calling on the phone and with the next hot tip or the next IPO or the next speculative investment idea, which really couldn't be further from the approach of a disciplined investment advisor and a comprehensive approach.
Right. It's amazing what effect the Hollywood has on the general perception of the general public, right?
Exactly. Yep.
Let's talk a little bit about some of the fears that you come across while you're out there speaking with your clients on a day-to-day basis. Please share one or two of the most common fears that they have about investing for us then, please, Chuck.
I think the biggest fear really, it's the fear of loss, but it boils down to a very simple fear of not having enough money throughout retirement. It's the way that it impacts human emotion is the fear of letting go of control. If you're going to rely on an advisor or rely on the capital markets to do their job, you have to let go of control to some degree. And that can be very frightening, especially when we worked our lives to earn and accumulate this nest egg. We want to protect it. And ultimately, having faith in capitalism and supply and demand is what's going to get the job done. But that can be a very scary thing for many people. Just that idea of trusting in the capital markets process. And then I think one of the other fears that comes about when you do have financial crisis, whether it was October of 1987 or the late 90s .coms or the Great Recession, any of those big negative events, it's that idea that maybe, just maybe, what if it is different this time? And I try to believe in investment discipline, and then what if the economy really is going down, which people thought in 2008. So those fears, while understandable and common, those fears can be assuaged by having a proper approach and proper diversification and just staying disciplined.
So what could one do to get past those fears then, Chuck? You essentially introduced the elephant into the room. So let's address that. How could one get past those fears?
Well, I think the biggest thing is, as we started the conversation, is just having a disciplined investment plan, one that's personalized to our own individual needs and goals, and most importantly, to our own risk tolerance, or what I call the sleep at night factor. I may look the same on paper as you, Stewart, in terms of our demographics, our age and assets and liabilities, any of those things, but we may be very different in terms of our risk tolerance. So it's important first to have a portfolio designed specifically and personal to you. I think that's a critical element. And if you're okay with and you only need a 3 or 4% return to accomplish your goals, while we'd all like a higher return, I should not be allocated into a portfolio shooting for a 12% rate of return, because when it goes negative, I'm not going to be able to handle that. So again, the bottom line is sticking with your disciplined investment plan and having it personalized to you. I think, the other real key thing, again, is, as I've also stated, is just really focusing on what we can control. We can control having broad diversification. We can control keeping our investment costs as low as possible. We can control staying in the market, staying disciplined. But we can't control all the other noise in the world and all the talking heads on television and the next crisis and the next, guessing as to what's going to happen in the future. So focus on what we can control. And then lastly, I'd say, allowing a professional advisor to help guide you, to walk you through those stormy waters when needed. That's what's helped the success of my clients, because, we are humans. We do have emotions, and it can get scary. So when I'm thinking about walking out on that ledge, I call my advisor and talk it through. What does this really mean? What's the best answer? And again, sometimes doing nothing is the best answer.
So, Chuck, you just mentioned allowing a financial advisor to help you. And as both you and I know, there are many people who are approaching retirement age, or they're on the cusp of retirement, and they're considering, who shall I speak with? Or what kind of professional should I be speaking with? And when they start thinking about certified financial planners like yourself, what are some of the perceived obstacles that they may have, or that may be preventing them seeking the help of a certified financial planner like yourself?
Yeah, I think that's a really great question, Stewart, because that is something we see every day in my industry. And I would think one of the biggest components or biggest obstacles is really this concept of illusion of control bias, meaning that this idea that I can do it myself, that the markets are always, they're always going to act rationally, and therefore I can make rational judgments and decisions, and I can handle this, even though it may not be where my education is or my experience or my expertise. For some reason, most people, we don't attempt to repair our own cars or, perform surgery on ourselves, but there's this false sense of confidence out there in people's ability to manage their own investments. It's as if there's a negative trait to, seeking help in this area of expertise. So I think that obstacle of really being okay with understanding the fact that I might need help, and in fact could probably do far better off by seeking that help, even if it costs a bit of a fee, because you can probably outperform that fee by just avoiding mistakes, for one, and lowering costs in your investment area. So ultimately, I'd say it's that idea that I can do it myself is probably one of the biggest obstacles.
So, Chuck, you've shared some really useful insights so far, and I'm sure anybody listening to the show in the future are going to be able to get some really valuable tips from what you've shared so far. However, having said that, could you just please share an example that really sums up how you've been able to help an individual or a business owner, somebody in the past, to succeed in getting the results they wanted, and obviously keep your clients' confidentiality in mind? So please, go ahead.
Yeah, absolutely. The common period of time throughout history that it's easy to remember for most of us who've had any investing experience is this Great Recession, that period of the 2008 stock market decline. And if we recall back to that, it was a period of literal doom and gloom, and people fearing that the U.S. economy was literally going to tank completely. We had lost a company like Lehman Brothers that had been around over 100 years, a major staple of Wall Street, so-called runs on the banks and the mortgage industry, and all those crazy things that had been happening. And in that market, it was pretty easy for many people to panic and fear that they were going to lose it all and want to get out of the market. But if we lean back on sort of the academic side of this industry, which is really where I came up, and you look at the Nobel Prize winning studies out of the University of Chicago and places, Dartmouth, MIT, Stanford, places like that, they remind us that these events can and do and will happen. Although rare in the market, they can and will happen. And really the only way to survive them and actually thrive through them is to remain disciplined. And in that time period, I remember very specifically the number of phone calls, kind of hand-holding that I was doing with my clients. And thankfully, most all of my clients listened to me, and they were able to, rather than throw in the towel and say November, December 2008, January, February of 2009, very beginning of March, when literally, people were saying the economy's over, we're done, save what you can, to keep people disciplined in that arena. And I can remember the voices of my clients and no fear in their voices. But ultimately, doing even what seems counterintuitive, rebalancing down into that market, selling out of some of your bonds and buying even more of those stocks, buying low. And that's what we did with our clients. And in March of 2009, when it seemed the world was ending, the markets took that incredible bounce, which, had you not remained disciplined, your ability to catch that or predict that or time that was really impossible, certainly next to impossible, scientifically impossible. And then being able to rebound and gain back those losses in a matter of a few years, as opposed to someone that did avoid their discipline, cash out, and maybe still is not healthy all the way to where they would have been even in, this many years later.
As a reminder, ladies and gentlemen, my guest today is certified financial planner Charles Korger, commonly known as Chuck to his friends and colleagues. And his topic today is keeping emotions out of investing. Now, with that in mind, and for those individuals who are listening in right now, Chuck, maybe you could share one or two unknown pitfalls or even common mistakes that they need to keep in mind no matter what kind of situations they find themselves in.
Sure, no problem at all. I mean, I think probably one of the key points to keep in mind there is really just that as human beings, we are not wired for disciplined investing. We have that flight or fight mentality that our brain goes to in times of crisis. And that works completely contradictory to what we need for a disciplined investment approach. That said, you have to be in it to win it, meaning you have to be participating in the market. You can't be sitting in cash on the sideline waiting for it to get better or, assuming that it's going to crash, because we just never know when those times are going to happen. So, that pitfall is avoid being in cash if you don't need to be in cash, making sure that you remember that your brain is working against you as well on the emotional side of it. The other common pitfalls are just, I think, people's overreaction to volatility. Markets are volatile by their very nature, and that volatility, it can actually be a good thing over time. It's what helps us, allows us to have rebalancing opportunities and allow higher expected returns after asset classes decline. So we can't be afraid of volatility, and I think that's one of the pitfalls and mistakes is people hear that the market's getting more volatile and they think that means they should get out. So I'd say avoid fear of volatility. Think of it as your friend. If my stock portion of my portfolio goes down, I get to just buy more shares for the same number of dollars. Mm-hmm. And I think those are some of the key pitfalls.
Yeah, I mean, there's some really interesting pitfalls that you brought up there for us, and Chuck. So again, essentially, you're introducing that elephant into the room, that what I like to call the financial elephant with the dollar sign on his trunk. Let's lead him out the room, show him the exit. How can people actually avoid those pitfalls? What should they do?
It's really those very same things that I've mentioned previously, which are, the number one thing is sticking with your disciplined investment plan. Mm-hmm. And, so how do we do that? That's by leaving our emotions off the table and not bringing them into the consideration. And, to have a disciplined investment plan, that means that you've done some groundwork before that to come up with understanding what your basic financial plan is, what your short-term asset needs are, your intermediate-term, your long-term need. And as long as those plans are in place and you know what you need to do over the long term, there's no reason to deviate from your disciplined investment plan. And if you're thinking about doing that, again, the last way to avoid that mistake or pitfall is, again, talk with your advisor. If you don't have one, find someone to talk with.
So, Chuck, when you think about all of the clients that you've helped throughout your long-standing career, you've been 30 years in the investment industry. When you think about all those people who you've helped to achieve the transformation that they were looking for, on a deep down personal level then, Chuck, how does that make you feel? What does it give you when you think about all those people you've helped?
I mean, absolutely. That's without question. That's where I get my reward from. That's where my fulfillment comes from. That's where the satisfaction in my career comes from. Obviously, we all like to have some monetary gain and financial status and the ability to support ourselves and those things. But, what gets me up in the morning and has a smile on my face as I'm ready to start the day and get to my job is exactly those types of things that you mentioned. Seeing the smile on a client's face when they write that last tuition check for their eldest child to college, or when they say, I'm actually approaching my retirement date. It's going to be there in a month. You can see the authentic gratitude in their eyes, and just being able to help people that on the 401k side of the world. I love being able to help my participants that don't otherwise have a lot of investment education or experience, and just being a teacher and educator and really informing on basic concepts and just giving someone the ability to be an informed consumer. I love that.
Right. I mean, the kind of work you do, I mean, it's really, finance is a dry topic, but the result of that, the transformation is really personal. I can only imagine then that with a lot of your clients that you're almost become an extended member of the family, right? Because like you just alluded to, some people cut a check for their child's college tuition, but maybe they started 17, 18 years ago and you were there right from day one, right?
Yes, yeah. You have truly lifelong friends, weddings, funerals, baby births, and deaths. It's, all that are involved, and you're able to be, part of people's lives and making an impact, hopefully for the better in their lives. It's a really rewarding experience.
From a layman's perspective, it sounds to me that you couldn't really survive doing what you do if you were only in it for the money, because it's a people's business, right?
Yes, I'd say especially on this, what I call the fee-only investment advisory and financial planning side of our industry. There's certainly ways to make more money in the financial world, whether it's investment banking or venture capital or those types of things. But you're not going to have the personal, emotional, and real impact on people's lives the way that we can in a one-on-one situation as advisors.
Right. So that said, that's a good segue into my next question then, Chuck. I mean, you're a financial advisor. However, I'm sure you didn't wake up one morning and just decide, yes, I'm going to be a financial advisor. There's always a long, winding path to where one finds himself today. So that said, please share a little bit about your backstory. What inspired or led you to become a certified financial planner?
That is a great question, and it's almost funny sometimes how a fork in the road occurs in life, and you take it and it has an impact, and that it did occur for me. I went to undergraduate college thinking I was going to be an engineer of some sort, maybe a civil engineer. I was really good at math and sciences, and as I started taking my science classes, I had a biology professor that took a subject and to me just made it even more painful and boring than it needed to be, while having an economics professor that took what I thought was a boring subject and made it very interesting and fun and real world. And I started taking more of her classes and less of the science classes. And ultimately, in the end, I came out of college with an economics degree and a double major with business administration and finance. And that led me into an interest and passion for the capital markets, and ultimately onto a bank in Chicago, starting out to understand investing on a more institutional scale, and then having the path forged to realize that I really did like working more with people and helping guide and advise people. And I really came up on that, as I said earlier, the academic side of our business, more the passive management versus active management, a couple key jargons in our industry in terms of whether or not you can pick stocks and time the market versus just having broad exposure and allowing the markets to work for you. And I was just always influenced by that side of the business more than sort of the insurance product sales or Wall Street stock mentality. And I've just always approached it more as an educator, creating, those informed consumers I talked about. And like I said, just really, ultimately loving the smile on my clients' faces is what has kept me wanting to do this and continuing to try to help more and more people. And as we know, the demographics are showing more and more people are going to need it as the baby boomers continue to retire.
Can you share a lesson that you may have learned earlier on that still influences how you do business today, then, Joe?
Yeah, I mean, I think there are many lessons in the business side of it. I think if we're talking specifically more about investing experiences in this business, I'd say, again, just stick with the discipline. I remember, back to 1999, pre-2000, the dot-com period. You can remember all these stocks, mostly out of Silicon Valley, were just going through the roof and trading at amazing, incredible, unrealistic multiples. And every news show, every radio station, every magazine was talking about, the tech stocks this and tech stocks that, and the death of small companies and value companies because you didn't have to invest in them anymore. Only large growth mattered. And, you start hearing that for a few months and then a year and then a second year. And consumers start to believe that, and they get swayed by that, and they get sold by that, really. And ultimately, I remember seeing, thankfully, again, I don't, not with my clients because I'd already been introduced to this idea of diversification, but many, many people back then, put 80, 90, 100% of their portfolios in those areas that ended up taking a 40 to 60% decline when that one segment, very concentrated segment of the market, took a hit. And, that was a very costly lesson for many people about the value of diversification. And I think it's, for some, some don't agree with it, and many have short memories about it. But to me, one of the great comments I always heard is that diversification is the closest thing you'll ever get to a free lunch. It's just, it allows us to be in the markets safely without, having to know that the specific technology sector was going to drop by 50%.
So, Chuck, before I ask my next question, I'd like you to do something for me. Is that okay?
Yes, absolutely.
So I'd just like you to just reverse the roles now, because I've been asking you the questions. Now, I'd just like you to put yourself in the shoes of your clients. And please share what could be one or two of the most important questions that they should ask themselves while thinking about investing.
Yeah, I think it goes back to, in my mind, to that idea of bias and this idea that I can do it myself. And the question I would ask myself is, is my money that I'm going to be investing, is it really smarter than the other 118 or so trillion dollars invested in the capital markets out there? Do I think I really know something that the overall markets don't know, or that supercomputers don't know?
Great question.
And we have this false belief as humans that we are going to win the lottery. We're going to know something that somebody else doesn't. I'm smarter than the next guy. I have better luck than the next guy.
I like it. Great question. Great question. So in your experience then, Chuck, what are some of the most important things, now still from the perspective of being in the shoes of your clients, what are some of the most important things that they should consider when evaluating a certified financial planner like yourself?
I think the very most important thing is just, is there an alignment of values and philosophy? Are you an investor who heard what Chuck Korger had to say today and that resonated with you? It makes sense. I'm on the same page of that. And I think many people that like this idea of more kind of the vanguard idea of indexing that John Bogle first created, but now we have ways to enhance on that and improve upon that. But generally that kind of a concept, if you're that kind of an investor, you want to be with an advisor who is geared towards that type of philosophy. If you're a much more active investor and you like picking individual stocks or betting on sectors or different exposures and things, you want to make sure that your philosophy is aligned with that of your advisor and the approach and the value. So that's number one. I think number two, and also just as critical, is are the advisor's fees reasonable and are they transparent? The fees can range. They can vary dramatically across the board depending what an advisor is offering in terms of, is it purely investment management? Are there comprehensive planning services? Are there, tax planning done? Is anywhere along the line you can have reasons for fees, but you just want to make sure that they are reasonable for what your services are and that they're transparent. And then I'd say probably the third thing is just, do I like this person as not even as an advisor? Do we like each other as people? A client-advisor relationship. Can I see myself, potentially becoming this person's friend? And I'm not saying that every single client has to become a personal friend, but in the end, many of them do because you have common goals, interests, values. You see things in a similar way, and you share life's ups and downs together.
Fantastic. Thank you so much for that, Chuck. Those are some great insights, and I'm sure that anyone listening in right now will want to know more. So if that's the case and someone feels they need to dig a little bit deeper into our topic today of keeping emotions out of investing, what would be the best way for them to get in touch with you, one? And two, what will actually happen when they do? Because I'd really like you to paint that picture so they know there is absolutely no risk to take the next step. Because sometimes you get to a stage like this where you say, oh, well, share your contact details. And the person listening says, yeah, Chuck shared some great information today, but I don't know what's going to happen if I do pick up the phone or if I do visit his website and send him an email. Maybe he's going to hit me over the head with a Fred Flintstone club and take all my money away from me that I've saved up all my life. So please paint the picture, share your contact details, and share with them what's going to happen when they do reach out to you.
Will do. So, yeah, as you said in my firm, Carson Choice, is located here in Bala Cynwyd, Pennsylvania, a suburb of Philadelphia. But we do have clients all over the country, and in fact, some foreign clients as well. So there's no geographic restrictions or anything of that matter. But to contact me directly, my email is very simple. It's just Chuck at carsonchoice.com. That's CARSON choice.com. And you can reach us by phone at 610-664-5550. We're also on the web at carsonchoice.com. You can find us at Carson Choice on Facebook and LinkedIn. And individually, you can also find me on LinkedIn and Twitter, Charles Korger. And as I've always done with my approach, there's absolutely no obligation, no commitments for phone conversation. Ultimately, I just having what I call a discovery call, where we just share some. The client would share what they're looking for in an advisor, a little bit about their personal situation. I would talk about how I might be able to help. And if that first phone call goes well, we would just set a time to meet, either again over the phone or in person, depending on location, and ultimately do a deeper dive into finding out more about the values, the goals, what relationships are important, all those important details outside of just the numbers for a client, so that we can really build a proper plan. And all through that whole process, and even through the submission of the initial plan and recommendations, there would be no commitment with the way that we operate, no obligation. It's not until ultimately someone would decide to become an investment management or planning client that there would be any fees involved.
Once more, ladies and gentlemen, as a reminder, we have been listening to certified financial planner Charles Korger. Thank you so much for sharing so generously with us today, Charles. You have certainly demonstrated that you are a true educator, advocate, and caring advisor for your client success. So thank you so much.
Well, thank you, Stewart. It's been a pleasure being on your show, and I've really appreciated the time to talk with you.
You are so welcome, my friend. And I'd also like to take a quick moment to say a big thank you to you. Yes, the listener. Without you, we wouldn't have anybody to speak to, and we'd be sitting here twiddling our little thumbs. So thank you for taking the time out of your busy day for joining us on this insightful and what I can only describe as a very informative discussion with one of the top certified financial planners in the Bala Cynwyd area today. Again, his name is Charles Korger, commonly known as Chuck. Make sure you do check him out. Give him a call. He shared his phone number. Visit his website. There are some great resources on there. I am absolutely convinced that whatever you do decide to do after listening to Chuck today, you are going to be in a great place to start addressing your current financial investment questions. So that's it, folks. Again, my name is Stewart Andrew Alexander, and we'll be back shortly with some more leading retirement professionals in this, our series of Let's Talk Retirement Conversations. So, until then, take care. Have a great day, and we'll talk real soon.
Thank you for tuning in to Impact Makers Radio. To listen to all past, present, and future industry thought leaders and trendsetters, visit us at impactmakersradio.com.